The RBI is set to make lending easier and structurally regulated for disciplined and result-oriented borrowers. Now, those borrowers could be anyone from your credit card users to MSME businessmen, small-scale businessmen, very small-scale vyapari. Anyone. Now, how's that happening? The Reserve Bank of India earlier this week proposed changes to the way banks assign risk weightage to loans and the so-called expected credit loss framework in a move aimed at aligning domestic regulations with global norms. The proposed changes seek to ease the risk weightage or capital that must be set aside by the lenders for different types of loans. Major changes include differentiated risk weights for corporate loans, loans to micro and small and medium enterprises, as well as real estate exposures. The RBI also proposed including transactors or credit card users, you and me, retail consumers, those users who repay dues on time in the regulatory retail category. As per the RBI, the proposed changes are estimated to have a positive impact on the minimum regulatory capital requirement of the banks. Now, the regulator also added that the segments such as MSMEs, real estate and credit card exposures will particularly benefit from these changes. How? Rated exposure to MSMEs will attract the same risk weight as corporate loans, while unrated MSME exposures do not meet the regulatory retail criteria but will carry a reduced risk weight of 85%. MSME loans qualifying under the regulatory retail category will be assigned a risk weight of 75%. Exposures secured by real estate players will be treated as per the norms applicable to the real estate asset class. For project finance, risk weights will range from 130% in the pre-operational phase to between 80 and 100% once the project becomes operational. For up to 2 loans, risk weights will range from 20 to 40%, while for the third and subsequent loans, they will range from 30 to 60%. In fact, commercial real estate exposures will attract risk weights of 100% for residential housing projects and 150% for other commercial real estate exposures. The RBI wants banks to assign risk weights that better capture the actual level of risk in each loan category for all kinds: corporate, micro, small and medium enterprises, even real estate. The RBI has also proposed a shift in how banks make provisions for bad loans. At present, as of now, lenders recognize losses only after a borrower actually defaults. The new system, known as the expected credit loss or ECL model, would flip that process. Banks will no longer wait for an account to slip into trouble. They will need to estimate possible losses beforehand and set money aside up front. So, if you are a defaulter, you need to worry, or if you are an expected defaulter, you need to worry. The aim is to catch signs of stress early, limit surprises and make the banking sector sturdier in the long run. The transition won't be abrupt either. The new system is proposed to kick in from April 1st, 2027 with a 5-year phase-in period. The long runway has been designed to give banks time to strengthen their data, analytics, build credit scoring systems and fine-tune internal risk models. A very small but noteworthy tweak concerns credit card users who always pay their bills on time. These disciplined borrowers, often called as transactors, could soon be placed under the regulatory retail category. That classification would allow banks to hold less capital against such exposures. In simple terms, responsible credit use might finally get a little regulatory reward. RBI also plans to expand the regulatory retail category to include transactors or borrowers who have fully repaid their credit card or charge card balances for at least previous 12 months and revise the credit conversion factors applied to off-balance sheet exposures. All in all, ladies and gentlemen, the idea of these changes is to make lending easier and to make capital allocation more accurate and less one size fits all. So if you're a credit seeker, a disciplined one, here is a news that will cheer you up.